Okay, great. Let's carry on. Great. Right. So, what are we saying? So, we've dealt with that one. Let's go again back to the question. So, I can come back to this. This is a little pup here that you have, that Scott has sold to Parker. So, we'll come back and talk about that. Then we have this. So, I think we have enough information now to look at goodwill. So, I'm going to use a different page for goodwill and call that working 3 because that's what goodwill is. So, you almost want to do like what I've done. You have working 1, and you have working 2, and then you have working 3. Now, goodwill, if you remember, typically we're looking at when I say consideration, we deal with the business as a whole. So we look at the consideration technically from 90%, which is what Park is bringing. And then, again, I'm just doing this so you can see, we must bring in the 10%, if you like, of the non-controlling interest. So the question will always give you what the fair value is of the non-controlling interest right at the start, at acquisition. So technically, you now have what the full consideration would be if you had bought 100%. And then, of course, we now deduct, of course, what the value of the business is at acquisition. And that's why we have working 2. So we kind of have working 2, the very first line, net assets at acquisition. So if we find this now, we can find out what goodwill would be, if you like. So let's work out this first bit, this 90%. We'll come back and plug the figures in. Let's use a new page. They tell us it is winded. It is winded because it says that you buy 90% of this business, and this business, they have 200 million shares right now. So you buy 90%, so you get 180 million shares. That's what you do. Each is £1, nominal value at £1. So that's what you invest in. But it says that this is how you pay. It says that for every 3 shares in Scott, you give, it's a different pen color, you give 2 shares in your business, in Parker. So I guess the straightforward answer would be then, well, how many shares have we exchanged for Scott's shares? Well, we have exchanged 180 million shares divided by 3 by 2 to give us 120 million Parker shares. And the next question must be, well, how much are our Parker shares worth? So Parker shares, we're told, are worth £4.90, I believe. Yes, let me just confirm that. Yes, £4.90. So you have exchanged shares. Let me just do the calculation. Yes, 120 times £4.90. So 120 million shares at £4.90 each, which takes us nicely to, let's just do the calculator over here. 120 times £4.90 takes us to 588 million. So you have exchanged the value 588 million. Then it says that you also do a loan issue. You do a loan issue as well, and that loan issue is at the rate of £100 loan note. And it says that you are offering something. Let's just go to the question. It says that you are offering almost there. It says that what you're doing is that for every it says here, for every 400 shares acquired, that you're issuing a £100 loan note for every 400 shares acquired in Scott. So let's go there. Let's go back. So you acquired 180 million shares. So it says for every 400 shares that you're offering a £100 loan note. Right? That's what you're ultimately doing. So for every 400 shares, you're offering a £100 loan note. And when we do this, we arrive at the lovely figure of 45 million. Yes. Let me just confirm that. Let's be happy with that. Yeah, 45 million. That's exactly what you've done. 45 million. in terms of loan note. So literally it's debit bank credit loan. It does say you've recorded this, by the way. This is the one you haven't recorded. You haven't recorded this issue of shares. So you have to go back. You have to make sure you include this when you're drafting your working 5. We'll come to that. So these are the two methods of consideration. Then they tell us finally that, so we have A, then we have B, of course, and then it tells us, of course, like I said, we must include the 10% of the 10% non-controlling interest, because we're given the fair value. We're treating it as 100% business, because we want to know what the consideration really is, because we're taking over. So 10% of the non-controlling interest we are given in the question. Let's just go back to that. Let's see if we can find what it is. And they tell us that at the date of acquisition, let's see if we have any, let's see, what do we have here? Right. Sorry, so no, it's not. Sorry, it's up here. We have here. That's where it is. This is where it is. We are told that at the date of acquisition, the market value of shares in Parker and Scott are £2.80 respectively. So 10% of those shares belong to the non-controlling interest. There's 200 million of them. So just going back to my page. So we have 10% of 200 million shares at £2.80 each, which come comfortably to 56 million. So now let's go back to our page, our initial page where we had this. So the 90% of Parker comes in at 588 million. Plus the loan of 45 million. Right. And then we also have the 10% coming in at 56 million. So the total consideration is 689 million. So in terms of the net assets at acquisition, we've already done this working, which is what, like I was saying earlier on, this is pretty critical that you're happy with this. And we see we've done that over here. We know what net assets were at acquisition. This is the full value of Scott at acquisition on the 1st of May. It's 461,775. So we literally just come back here and deduct the 461,775, and we now know what the goodwill is. Goodwill on acquisition. And we take this away from this, and you should have 227,225. Brilliant. Now, again, whenever you do these type of questions, look straight away to see if there's any impairment. Just so, I guess we can deal with that now as well. Now we know that what's going to happen is that literally, it's in terms of impairment, it's credit goodwill and debit the consolidated income statement. That's what we're going to do. Yeah, and that's kind of the process. Let's just see what it is. It tells us that consolidated goodwill is considered to have been impaired by £1 million. So it's fallen in value by £1 million on that day. So we know at some point, 1 second, we will have to deduct £1 million from here. This is an asset right now, right? An intangible asset. So it will fall by £1 million. So it's up to you whether you sort of do it now or you just make a note of that that's going to fall by £1 million. Right, but you know that you would have the debit in your consolidated income statement when you get there. If you had to do one, it's really about whether or not you have to do one. In this question, you have to. So we're going to have to include £1 million into our, if you like, into our consolidated income statement. Cool, great. So let's go back to the question. Let's see if we can do something just around the 10-minute mark. If there's anything else we could do, this keeps flicking all the way back to the front. Come back here. And we will see that we have, let's look at what else do we have. What other adjustments can we deal with? So that's working 3 sort of done. Let's see if there's anything else we can do with working 2. Okay, great. So for working 2, so technically we have dealt with this first adjustment. Then let's deal with this one. We've technically done with, it says, oh no, let's deal with the second adjustment. So this is a PUP. Right, great stuff. So let's deal with the PUP just before I close this video. So I'm going to open up another page, but just to deal with this. So I can call this. I guess I could call this working, because typically we leave working 5 for our retained earnings, and working 4 for our non-controlling interest. So I can call this working 6. I can probably call this working 6 if I haven't used 6 already. So over the entire year, Scott, so this time, because Scott's selling the goods, so let's go, Scott sold some goods worth 48 million at a margin of 20%. So, and Parker still held 6 million of these goods. He had paid for except for these final 6 million goods. So what we really have here, I'm just going to call this working 6 pup. What we really have here are inflated is a case of inflated inventory and therefore inflated profits. Now remember, this business is coming together, right? These are two companies that are coming together. And just to give you a kind of a flavor, I always like doing it this way because I think it makes sense a bit when you look at it this way. Literally, what we're saying is that you had some inventory worth a certain amount. I'm just going to call it X, just sitting in there. And just because you moved it from one room to another, because that's all that's happened once you're now one company. You're not selling outside your company anymore. You're within the company. So once you move from one room to another, all you've done is moved it from one room to the next, and you've suddenly put some kind of increase or some sort of margin on top of it. And literally just gone, add profit, so increase in profit, increase in asset, just by that margin. But remember that you're not selling it outside the company, you're within the company. So really we need to get rid of that margin because it's just not true. You can't just increase A for the sake of it, the asset of inventory, because in this case you're selling to yourself. So you had bought some goods for whatever and now you've sold it to yourself. So we need to get rid of the selling transaction, the expense, just get rid of everything really, because you cannot sell to yourself. So let's look at the scenario. It says that there is a margin. So basically, Scott sold the goods to Parker for 6 million. Well, what does that mean? Oh, sorry. Let's just see. So it says here that Scott sold goods, throughout the whole year for 48 million at a margin of 20%. So what we have here is a scenario that we look carefully at this, we will see that what we want to try and do is to find what that margin is. So if you like, what we sort of want to do is to, let's just get a working page here. Yes, is look for that margin. So let's just use I think this is the page I'm working on. Yeah, let's look. So we have this current inventory sitting there right now, and again, because it says it's a margin of 100%, that's at, if you like, 100%. So what we're really trying to find ultimately is that, well, if Scott had sold these goods, for example, to Packer at 20 million as a whole, but 48 million as a whole. We'll come back to the sales, but let's just focus on this issue here of the 6 million outstanding. It's currently sitting in Packer's inventory at 6 million. So Scott sort of sold it, if you like, at 6. So it's 6 million at a margin. So that, if you like, there's a 20% profit right now on these goods. So definitely it means that the goods themselves really only cost, if you like, 80% of 6 million, because right now Scott is claiming that they have sold these goods for 6 million, but really the goods are only worth, if you like, if you do the maths here, you will see that the goods really are only worth 4.8, and so they should be recognized at 4.8 and not 6 million. So we need to kind of, I'm going to use a different pen color just to emphasize what's going on here. We need to then reduce these goods right now that are sitting in Packer's closing inventory by 1.2 million, and therefore deduct the profit of 1.2 million from Scott's retained earnings, because Scott right now is recognizing retained earnings of 1.2 million that are not really profit. They're just inflated profits, or unrealized profits, if you like. So what we definitely need to do is be deducting 1.2 million from Scott's retained earnings. And the reason I want to do this first is just because we have a kind of a working two here, where really the double entry, if you like, is debit retained earnings 1.2 million and credit closing inventory, but this closing inventory is in Paca's inventory, and we see that when we do the statement of profit or loss when we add the two together, right? We'll deal with that there. So that's this. So that kind of deals with our working two right now. And let's go back to just look through to see if there's anything else that will go in that working two. We've dealt with this. We'll come back and deal with this when we come to the income statement. Purchased a number of shares. So this is to do with Paca, and this increase, if you like, is to do with Paca, nothing to do with Scott. Then it says, this we've dealt with. It says that they have a non-controlling interest at fair value. We've impaired goodwill, and we have dealt with the profit. So we can comfortably kind of close off working two, and when we do that, we have 200 plus 216 plus 60,625, less that, and we have 474,175, if you like. And of course, the 625 and the 1,200 come here, leaving us with 12,400, if you like, as the post-acquisition profits. Right now, so there you go. That's kind of this was the hardest one to do. This working two, arriving at working two, and dealing with those sort of the PUP as well, just being very aware of what's going on, and dealing with working three, which was goodwill. So let's kind of now deal with let's see who we can deal with next. Let's deal with working four. Yes, let's deal with working four. So working four really tells us what's going on at the beginning. The beginning, we have our non-controlling interests, and we know what the fair value of our non-controlling interest. We want to see what's the growth pattern of our non-controlling interest. That's what working for is. Remember that this working for is going to go under our equity section in our statement. Oh, I've gone so long, I've stated the financial position. So what I'm going to do is I'm going to end this here, and I'm going to do working for in the next video.